Alright class, welcome back. Today we are going to begin Chapter 3, Part 2. Some of the topics we're going to be discussing: business transactions, accounts receivable, accounts payable, an investment, and what the term on account means. So let's get into it. The first thing that we're going to talk about is a business transaction. So a business transaction is pretty much anything, any purchase of assets, anytime a business either spends money to buy something, pays a bill, receives payment from a customer, borrows money, anytime anything happens that affects the business, we call that a business transaction. That's what we have to record as accounting clerks. So, technical definition: a business transaction is an economic event that causes a change in either an increase or a decrease in assets, liabilities, or owner's equity. And those were the things that we discussed yesterday in Chapter 3.1. So the first thing that we're going to look at is what is an account. Okay? An account is a subdivision under assets, liabilities, or owner's equity. So simply put, you have an asset, something of value that a business owns, but under assets we have different accounts, right? So you could have a cash account, that's an asset. You could have, we're going to learn about accounts receivable, that's an asset account. You could have a land account, you can have an equipment account. These are all accounts that would fit underneath what an asset is, or it's a specific type. So we're just giving it a little bit more description. We're naming it something. There could be a liability, right? Accounts payable, the name of the company that you owe the money to that you borrowed. Or a capital that can also show your owner's equity. So all an account is it's giving a name, or it's a direct category for each of the assets, liabilities, or owner's equity that we discussed. A business records changes in subdivisions called accounts, such as accounts payable and accounts receivable. Alright, so let's move on. So what exactly is accounts receivable and accounts payable? The first one we're going to talk about is accounts receivable. Accounts receivable is the total amount of money owed to a business, money to be received later because of a sale of goods or services on credit. So what that means is this: somebody came into your store, they bought something, and they're gonna walk out of the store with the item that they bought. Say that they came in to buy a toaster. So we sold them a toaster, but they're not going to pay us cash right now for the toaster that they bought. We're going to wait to receive the money for it later. So accounts receivable means that we sold something to somebody, they took away the good, or we provided a service, but they're going to pay for it later. So we're waiting to receive the money that they owe us. That's what accounts receivable is. Accounts payable is the amount owed or payable to the creditors. Those are the people that we owe money to. So say that we went into a store and we bought something, and we went in, we needed a copy machine for the office. So we went to Staples and we went to the register, we bought the copy machine up, we took it home with us, but when it came time to pay, we said, well, we don't have the cash right now, but we're going to pay you later for it. What's accounts payable is that's how we keep track of the money that we owe to people for products or services that we got, but we didn't necessarily pay cash for it. That's what accounts payable is. Alright, so there's a process that we have to go through in order to analyze these business transactions and come up with what are the right categories, or what are the right accounts that they need to go into. First step we have to do is we have to identify the accounts that are affected. Which accounts are affected? In double entry accounting, there's always two accounts that are affected by every transaction. The next step is to classify the accounts. What classify means is we want to know, is it an asset, is it a liability, or is it owner's equity? What is the class of the account? Finally, we have to determine, alright, well, is that account going up or is that account going down? We need to determine the amount of the increase or the amount of the decrease for each of those accounts. And last is we have to make sure that the accounting equation remains in balance. Remember, every time one of these transactions takes place, our accounting equation, assets equals liabilities plus owner's equity, must stay in balance. So after every transaction, we have to make sure we go back, we update the balances, and we make sure that they're even. If there's something there that's not in balance, we have to stop, reanalyze, and figure out what the correct accounts are that need to be affected. An investment. We're going to talk about an investment in this class. So an investment is when the owner takes something of value and puts it into the company. Remember, they're two completely different people, right? So you have the person who may own the company, but then you have the company itself. An investment is when the owner takes something personal, something that's theirs, and gives it to the business to use. Remember, the business and the person can't own the same asset. It has to belong to either the individual or that has to belong to the business. So if I was going to start a business and I had $1,000 in my personal checking account, the one that I use for my regular bills, but I wanted to take that $1,000 and I wanted to give it to the business to use, that would be considered an investment. I'm taking it from my own personal account and now I'm giving it to the business, and the business has that $1,000. Or let's say I had a computer at home and I wanted to take that computer and I didn't want to use it anymore for my own personal use. I was going to give it to the business to use. I could then take that computer, give it to the business, and I'm investing that asset into the business. So an investment is money or any other property, remember something of value, that's paid or given to the business to produce a profit. So it's something of value that's personal, that's now crossing over into the other world. I, as Mr. Viviano or the business owner, no longer own that asset. The company now owns that asset. I'm investing it into the company. All right, I think you got it. So let's take a look. Let's start to analyze some of these business transactions. The first transaction that we're going to analyze is that Krista Vargas, she's the owner of the company, took $25,000 from her personal savings account and deposited that amount to open a business checking account in the name of Zip Delivery Service. So that's her company. She's taking $25,000 of her own money and now she's giving it to the company. So the first thing that you have to determine is you have to figure out which two accounts are going to be affected. All right? So in this case, she is investing cash into the company, right? So if we look here, cash in bank would be the first one. Cash in bank is an asset, so the asset would be affected by it. So yes, the asset, cash in bank, is an asset, and that's the asset that would be affected by it. Is the business's cash going up? Absolutely. She's giving it $25,000. So you see an increase of $25,000 in cash. She's not taking out a loan, it's her own money. So she would have the claim, or she would have all the equity. If you were to go and sell tomorrow, she would get that $25,000 back. So her owner's equity, or the account that we call as capital, would also go up $25,000. Did we stay in balance? Yeah, we did. Our assets went up $25,000, and our owner's equity or capital account also went up $25,000. So our assets equal liabilities, which are zero, plus owner's equity, $25,000 on both sides, and we're in balance. That's the first transaction. This is what it looks like in a chart. See, we have our cash and bank account. We increased it $25,000. These other accounts didn't get affected. So computer equipment, zero. Office equipment, zero. Delivery equipment, zero. Those assets didn't increase, only cash. Accounts payable, remember, that's what shows how much we owe. That's not affected. But our capital account, which shows the owner's claim to the assets, absolutely, it went up $25,000. Okay? We just run down the balances, 25, 0, 0, 0, 0, 25. Now on both sides of the equation, remember, here's the equal sign, right? So on both sides of the equation, we're in balance. 25,000 on this side, 25,000 on that side. Let's go to the next transaction. So in this transaction, it says Krista Vargas transferred 2 telephones valued at $200 each from her home to the business. So in this case, yes, it's still an investment. She's taking things of value that are her own, and she's giving them to the company to use. So it was 2 telephones, and they're each $200. So the total value of that investment would be $400. The two telephones times the value of $200. She's making an investment of $400 into the company. So now let's look and let's figure out what accounts would be affected. So you have your list of accounts, and in this case, she's not investing cash, right? No, she's investing office equipment. And she's investing $400 worth of office equipment. So she would have office equipment of $400 increasing. And in this case, if she were to sell those telephones, would she get back the full $400 for the telephones? Absolutely. So her owner's equity also has to increase by $400 to show that she has a claim to that $400. Okay? So owner's equity goes up, and office equipment also goes up. So let's take a look at it on the chart. Remember, we still have the transaction, the first one that we did, the $25,000. But in this case, is cash being affected? Nope. Computer equipment? Nope. Office equipment, yes. Remember, the business now has $400 more of office equipment. Delivery equipment, not affected. Was there any loan coming out for this? No, it was her own 2 telephones. So, did her claim to these assets increase? Yeah, absolutely. Because if we were to sell the $400, she now would get $400 more back. So you have to add that to the owner's equity. So let's see. Let's bring down the balances. 25,000 still stays, 0. 400 comes down, delivery equipment 0, accounts payable 0, capital. So now look, in this case, because our capital increased, we now have a new balance. The new balance in capital is 25,400. But let's look, remember here is the equal sign, okay? So it's our assets have to equal liabilities, the money we owe, plus the owner's equity. So if we go on this side and we were to add up our assets now, how much do we have in assets? We have 25,000 that we started with the cash. Now we have $400 worth of telephones that we got. So when you add those two up, we have 25,400. Yes, it's equal to the 25,400 that we have on the owner's equity side. So far so good, we're in balance. Our assets equal our liabilities plus owner's equity. Next transaction, let's go. So, transaction number 3, it says Zip, remember the name of our company is Zip Delivery, issued a $3,000 check to purchase a computer system. So guys, anytime you hear the word check, I want you to think of cash. Check is the same thing as cash. So in this case, the owner's issuing a check because remember, the checking account is where we keep all the business's cash. So if we're issuing a check, we're basically telling the bank to pay somebody or some business some of our cash, okay? So here we go. We issued a $3,000 check to purchase a computer system. So again, what two accounts are affected? If we're writing out a check and a check is the same as cash, our cash account's affected. And in this case, if we're writing out a check and we're telling the bank to pay somebody some cash, is our cash going up or down? Cash is going down. So first account, cash affected, but in this case, we're actually decreasing cash $3,000. But what are we getting in return? We are buying computer equipment. And what's the value of the computer equipment that we're buying? Well, if we're paying $3,000 for it, the value of it would be $3,000. So we would find our computer equipment account. And in this case, remember, the computer equipment account shows the value of all of our computer equipment, right? So in this case, we're increasing it $3,000. So we have our two accounts. We're good. Let's go take a look at the accounting equation and see how it works out. So the cash go up or down? In this case, cash actually went down $3,000. Computer equipment, we just bought some, so it increased $3,000. Was office equipment affected? Nope. Delivery equipment affected? No. Accounts payable affected? Nope.